Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guy TV. Now, we got a lot of balls in the air, so we're going to look at a trade that we did a little while back that actually should be panning out quite good. We did a show on NVIDIA's downturn because of DeepSeek and that news hitting the marketplace. And we're looking for a dead cat bounce in general is an old term that has been used in the marketplace for a long time, where if the market does come back, we want to try to double up on our NVIDIA position without adding any additional cost and without adding any additional risk. I'd like to call this a covered call on steroids. So that trade, in case it did happen, I just want to make sure that you would close it out today because I don't want you to get exercised and end up buying extra shares of NVIDIA. And the brokerage firm, if they're doing things right, should close you out if you don't have the capital to buy NVIDIA. But I want to go over that trade and I want to talk about some of the risks about falling asleep on your option contract and not following through with the trades as expiration is approaching. All right, so to start with, I want to look at the Coinbase trade, and we on Wednesday talked about doing a trade in Coinbase that was a butterfly. Coinbase, oddly enough, ran up $23 yesterday heading into the close, into earnings, and this morning is now down 7%. Or basically given the entire move back. So let me talk about this trade, and it's something that you would want to be all over, and you might have wanted to get out this morning if you put the trade on, because once again, it's a high risk, high reward type trade that we did. We did a butterfly, and right now it's stubbornly staying below our strike. So let me set up the trade that we did. Let me grab it over here. That we have on. Okay. So Coinbase was at 268.61. It is now 277.55. We had very expensive options. The 280 was trading for $6.60. It's now trading for $2.10. And so that was almost all implied volatility is what you were paying for if you bought the 280 strike with the stock at 268. Now, the market has ran up, and maybe I should let's go through the trade, and then I'll show you the chart. So this morning, you had potential to get out of the trade. Depends on how much implied volatility actually came in and crushed the option contracts. But when we put the trade on, this was trading at the midpoint. Here's the butterfly, and I'm going to send it. Let's send it to the what if calculator. Maybe that'll give you a little bit of a hint if you did not watch the show, and then shame on you if you didn't watch the show on Wednesday. But you can go back and review the archives if you'd want. But the way that we set up the butterfly is we went about the expected move, which would be right around I think it was right around 286 or 287. And we said we hope that the stock lands somewhere between 280 and 297, but it doesn't really matter. As long as we get above 280, everything is good on this trade going forward. We modified this, and that makes this butterfly worth $2.50 on the end of the trade. We put the trade on. It was trading for $1.25, $125 per 1x2x1 butterfly. You can adjust your risk accordingly if you did 2 or 3 or 4 of these. And now we got the stock annoyingly hanging right below the 280 level. It opened today somewhere in this range, somewhere right around in here, inside the wings of the butterfly. But now it is down. It actually shot all the way up to over 300 yesterday, or right around 300, and now the market's all the way back down. So you could have gotten out yesterday, but implied balls would have been really high. You would have been profitable on the trade. Should have grabbed a screenshot of it last night on the close, but I didn't. I would, and I'm actually really curious what it would have been trading for now. Maybe I'll have to go back and check that all out. Just because vols would have been so high and it would have blown through our strikes. But this is where we're at right now. We got the stock here. We got this here. We're trading. We can get out at break even. Well, at 150 now. At 154, we can make a quarter on the trade. Or do we let it ride into the end and hope that the stock bounces back and goes to 280? But it's going in the wrong direction. All right. So bottom line is if it ends up somewhere between 280 and 290 at expiration, well, this thing could trade for $10. It could trade for that. And it's very possible that it could trade somewhere in the middle of that, because we're at noon on Friday and we're right at the bottom of our strike. So we're really close. But if we wait and the stock drifts lower, we're going to lose this value right away. So we're at 160 now. It looks like the market's moving a little bit. So it's really a coin toss. If I had more than one of these on, I would probably, let's say we had 3 butterflies on. I would probably close 2 of them right now at this moment. I would have closed them on the open, but right now at this moment, and then let one ride. That's the way I would approach this trade, just to make sure that maybe speculate on one of the butterflies and then let the other one ride. So that's why I'd like to do 2 or 3 if I'm doing these around earnings. If you got more risk capital, you can do 4 or 5. But you're got the potential to lose it all, right? Especially in if we need the Coinbase to come out and have a positive effect after the earnings. Okay, so let's go look at the trade. Here's where we're at, 279. So we're bumping up towards the 280. Here's where the chart is. Let me pull this up. And this is a 1-minute chart from the beginning of the day. So here's when the market opened, and the market actually opened up at 291.20, which is right on our middle strike. I doubt you would have acted right away, and on top of it, you would have implied vol still would have been fairly high, but this was right at our middle strike. Came all the way down. Now we're at 940. Now at 945, we see a bounce up to 286. So we're trading in the middle. I would have wanted to get out probably then, but then it came all the way down to 276. And this is the point where you would have panicked. You would have been like, oh, the market is the Coinbase was right in the middle of our butterfly, and now it's bounced down and it's trading at 276 right at 10 o'clock, which is a time when a lot of people will trade after an earnings report just because everything kind of gets settled in. And then it had a strong move back up. So it's been all over the place. I would have tried to trade somewhere. If it would have opened up, came down and bounced back, you would have been like, okay, I don't want the cheese anymore. Just let me out of the trap and just be done at 286 and just get out of the trade. Now we're here, and now it's starting to settle in. And it looks like the trading range on the 1-minute bar is between 279 and 277. At 280, we're in the money. At 277, we're out of the money. So real tough call as to stay in it or not. And I'll let you make that call. You could get out at break even right now. 142, 136. Yeah, right around. Just make a few pennies on the trade. But that's not what we were looking for. We were looking to make a few dollars. All right. Coinbase. Any questions on the Coinbase trade? If you have any, please do put them in the chat box. Oh, Jay got out. Yay! Way to go, Jay. Whoop, whoop. All right. I'm glad to hear that, Jay. I needed some good mojo from that trade, because that one kind of makes me annoyed. I'll be blunt. I'm annoyed that the stock ran up so much yesterday, and then I turn around and after the earnings report, it's right back at our middle strike. So that really annoyed me. That this happened. I couldn't even make it to the show, and it stayed within our strikes. I would have been fine if our show was at 9:45 today, but which will put the stock right there at 286. So I'm glad you got out for 250 at the open. All right, excellent. Here we go. Now, if you go back to, let me actually see if I have we did an NVIDIA trade. And it's a trade. I'm going to go into detail on it. I'll be blunt. On Monday, we don't have, the markets are closed. So I'm going to tape a video that's called Covered Call on Steroids. And when NVIDIA got crushed because of the DeepSeek news, and everybody thought that nobody's going to buy NVIDIA chips anymore, which was just a joke. We're looking for a dead cat bounce. I went through 3 different scenarios. Talked about just buying a put outright as protection. Talked about doing a covered call to try to bring in some premium. And then also looked at doing a collar trade. And we can move out a little bit right now. We can bounce out on the video. Okay. And then we looked at doing a collar trade. Now, finish the show with a covered call on steroids. And I own NVIDIA in one of my accounts. In a couple accounts. And I did this trade. So I'm getting out of the trade today. My strikes aren't the same as we talked about on the show, because I actually did a little bit later in the day, and NVIDIA actually came back. So the show actually was a better version of the trade that we talked about. And you can see this if you go to the Tradier Hub and you go back into the archives. You can actually just do a symbol search for NVIDIA, and it will turn out, and you'll be able to find it straight. Hub.tradier.com. That's what the words I'm looking for. So here's what NVIDIA did. And let's go NVDA. We'll pull up the minute chart, and then we'll go out in days. And we'll put 800 days in it so that we can see the move. And the stock came all the way down to 112. Okay, so here's the area of the chart that we want. And then look at it since that move down to 114. Thank you, by the way, going to the chart again. 114, and look at all these. There's not a red candle at all since that happened. So we actually bought a 131 call and then sold 2 of the 137s on that. We sold 2 of the 137. So we're right at it. So you got to do something with this trade. And so let me set this all up. Let me go put it all together, because expiration is the 14th. Yeah, this is today. Wow, I don't think we've ever got the numbers exactly right. And I think that this might be the first time. If it stays at 137, we'd like it to be 136.90 is where we would like it to end, and let our short option contracts expire worthless. But this is assuming that we own stock. So everybody got the Coinbase, close it out. Now we're looking at NVIDIA, NVDA, assuming that we owned stock. And that's a lot of people do. So this was a protection strategy. If you own stock, you could buy protection on the downside, try to find a cheap way to do that. That wouldn't have killed you in NVIDIA, as opposed to selling the stock you owned a long put. But you would be down on that long put and you'd be losing money. You would have made a lot more on NVIDIA's bounce back, but you'd be down on your put. This trade was, we're going to bring in a small credit, and we're going to basically leverage NVIDIA between 131 and 137. And I'll grab the graphic, and I'm going to show you this now. This is a scary graphic, and in that it's showing unlimited risk. But you got to realize that we actually own the stock. So here's what the trade was. Market was at a net credit of 46 cents. We did the February 14th expiration. We bought the 131 strike call and sold 2 of the 137 strike calls. The fact that it's a 1-to-2 ratio means that we are naked short. But guess what? If you own stock, you're not naked short. And you flip that whole graph up. I guess it would be backwards here on camera, but you'd flip that whole graph up. And from 137 on up, you would actually be profitable on the trade. And between 131 and 137, it's like owning NVIDIA on margin. You're 2-to-1 between the strikes. So here's where that trade is at now. And I do mean this, in that if you don't do something with the position today, if you had it on and you don't close it out, they're going to put a couple hundred shares, or then put at least 100 shares of NVIDIA to you, because the 131 strike call is in the money. So right now, the 131 strike call should be trading close to its intrinsic value, which is almost $6. Very little intrinsic. There's very little time premium left in them, because we got 1 day remaining to the. Oh wow! It listened to us. 136.85. Wow! If it went out right there, that never happens. That just never happens. It's fun though. Okay, let's add this one. 131. Okay, and we sold 2 of these. Now the only thing that's annoying is this is still trading for 50 cents. So if you close the entire trade out right now, you'd sell this thing for $4 and let's call it 70 cents. 470. You put the trade on when it was initially entered for a net credit of 46 cents. So you're going to make $5 on this trade, and you didn't put any additional risk in. You didn't put any capital into the trade. You did the trade for a net credit of 46 cents, and you were able to sell it for a credit of $4.70. Now you would flip the script, right? You'd be selling this one to close, and you'd be buying this one to open. And that would be the net credit of 470. So you don't want to be assigned on the 137s, and it's staying right there. You don't want to be assigned on that. So from 131 to 137, you are long an extra call option. You're long 100 shares of stock, and you're long an extra call option. So if we take this, send this to the what if calculator, and oh shoot, I had it upside down because I flipped the script. Let's buy the open, sell to open, send to the what if. All right, and then let's add the stock. Add equity. Sorry, I got a frog in my throat today. So this is the way the trade would have looked like. The market was all the way down here, down around the 120 level. This is where, I mean, your stock on margin from 131, you own 100 shares of stock and you own 1 call option. So in here, we get much steeper on the profit and loss graph, all the way up to the 137 level. And then from 137 on up, if you're in this trade and you let yourself get assigned, you're going to get your stock taken away, and then you're going to have an issue with your option contract. So right now would be actually a really good time to get out. It's at 136.21. If I had this position on, and you do one of these for every 100 shares of stock. So in one account, I have 300 shares of NVIDIA. I did it 3 times. And right now, I went yesterday and I actually closed the 137s out in one of the accounts. I got 140s in the other one. But 137s, I closed those out for 11 cents, 12 cents. And so now I can let my 131s just ride. And that's simple. That's what I'm looking to do. And I have the 132s. I don't have the 131s. But I'm just going to let those ride. And I put in a limit order to sell those right around $5, somewhere close to that. They're at $4.50 right now. So that's where we're at. Interesting trade. Very interesting. Covered call on steroids. I'm going to go through the steps of it today. I'm going to put together a little bit of a PowerPoint. We're going to tape a show. We'll be putting that out on Monday because the markets will be closed in honor of our presidents. President's Day, it is on Monday. And I'll go through this strategy inside the options playbook. I guess let's run out and I'll pull up the options playbook. Let's go out let's step out. Thank you. And I'll show you what it's called is the front spread. But once again, you got to own stock in order for it to matter. I'm pulling up the options playbook, and it's a front spread with calls. And here it is. Okay, so go ahead and let's do the playbook view. And we got that on. So if you don't own stock, you have a nice risk reward from strike A to strike B, but you have unlimited risk because you don't own the stock. So once again, you flip the script, but this is what it is. You add 100 shares to this position, and that profit and loss graph turns. And it's not a bad profit and loss graph. The biggest thing, the reason why this worked, let me get back to that. The reason why this trade worked out was NVIDIA got beat up on the downside. And when that happens, implied volatilities fly, they skyrocket because everybody's nervous and they're running to the options marketplace to try to protect the stock. So this trade doesn't give you a lot of protection. If you just sold strike B and you just sold one call on your 100 shares instead of two calls, which we're proposing here in the front spread, you're going to get a lot of time value. But here we're saying we're going to bring in a little bit of time value, and we think that this is overblown. We think that the market should come back to where it was at, and it was at 140 when all the stuff hit the fan. So ideally wanted to say that, within a couple of weeks, we could see the stock coming back to where it was. Maybe this is all because it's not, NVIDIA didn't go down because something fundamentally was wrong with the company. It was just anticipated that people wouldn't be buying as many chips, and the demand hasn't gone down at all. So it's bounced back to where it was. So covered call on steroids. Bring in a smaller amount than if you sold the call outright, but you make more because you are long an extra option contract, and that is in between the strikes. So you can go back and look at the show if you'd like. Just go back and look at the archives and see where that is at. Now, one other trade that we did, and don't want to. Doug's saying take the money and run. I would agree too. Where are we at, by the way, on Coinbase? Let me just add it to my watch list so we can keep an eye on it. 275. Yeah, it's hurting now. It's hurting. You could have taken the money yesterday and ran. I wonder if, Jay, did you look at it yesterday on the close? See where I was at? NVIDIA. I really like the NVIDIA trade. I'm really glad that one worked out. I'm really happy about that whole scenario. So SPX, because we've done a couple of earnings trades this quarter, honestly, that haven't done as well as I would liked. 6,114.33. 6,114.33. We got whiplashed on this. We went in and got long the option marketplace on Monday, did a long call spread. On Wednesday, we adjusted it. Now, I did talk about adjusting it where we brought in a smaller credit, but we had the modified butterfly on, something like we had on Coinbase. That turns out would have been the better trade to do. I suggested that we would just do the butterfly, but now the market has shot through that butterfly strike and gone beyond. So the market is going where we wanted it to go at the beginning, but we over adjusted, I guess, if you will. And when it hit the short strike on the way back, should have got out of the trade, should have made you a few pennies, but it would not have rewarded you because it came back way too quick. And we're trading at this level right now. So let me grab the strikes. And the butterfly's probably trading for nothing at this point in time. Let me see what strikes we had. Coinbase. We were on the 60, 55, and the 60, 65. Yeah, 60. Let me pull it up. The font's too small for me. 45, 55, 65. Okay, so 45. Yeah, markets are wide in it because it's deep into money now. February, we got the right expiration. 45, 55. And I go back and I look at this. Sometimes I try to manage costs too much. and I will do like we did at 10 points wide. 15 points wide on the initial long call spread is better, and that's what I normally do in my account. But the cost is there. Yeah, it's trading for nothing. It's trading for a dime. All right. Now, if we modified it and we brought in the smaller net credit, well, then we'd be fine. Then this trade would have helped out, and we would have broke even on the trade. But you would have brought in a smaller net credit, and I did not recommend doing it. But I said this is an alternative. So you would have we would have sold this spread, and let me click on that. And now it would be trading for $5, which makes sense. So we would have put the trade on for $6. We would have brought in $1 plus on our credit spread on our hedge, and then we'd be trading for $5 right now, and we'd be up a smidgen on the trade, 50 cents maybe $1, somewhere in that range. But the market came back, and it just came roaring back. It just came flying back. News headlines are all over the market. The market can't decide where it wants to go. With everything that's happened with the new administration, it makes it hard to, because the market's reacting to all the news headlines that are happening. And 1 minute there are tariffs, next minute there's not tariffs, next minute it gets kicked down the road, and it's just hard to trade the market because news headlines are driving it much more than fundamentals. It's simple. We call a spade a spade. All right. Any questions that we have? Like I said, it's kind of a big show today because of all the trades that we had on. And the Coinbase trade just was annoying. I was so annoyed last night when I saw the after hours trading that it was starting to lean to the downside. Okay. So you closed it yesterday for 250. Okay. All right. Sounds good, Jay. Appreciate you sharing. I do. Sharing is caring, Jay. My name is Brian Overby. I'm going to close this session out. We're right at 11:30. Monday, the markets are closed. I'm going to go through the concept. I'll probably use the NVIDIA example, and I'll put some slides together and talk a little bit about the setup for the covered call on steroids, which is known inside my book as a front spread, but you got to attach stock to it. And that will be the show on Monday. So if you want to check it out, please do so. We'll launch it at the normal time, 11 o'clock Eastern time, on inside the Tradier YouTube channel, inside the Tradier Hub. And we also toss it out on X under my profile and the Tradier profile. So always appreciative of all the different forms of social media that you can watch it on. And we'll see you then live again this coming up Wednesday on the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.